the real reasons behind the crypto crash, and what we can learn from Terra's fall. Crypto markets are in freefall this month, and their struggles have been gravely exacerbated by the demise of a $60 billion project that critics are calling a Ponzi scheme. The project in question is Terra, a stablecoin pegged to the US dollar that its supporters hoped would upend traditional payment systems across the world. But it was wiped out in the span of days when investors panicked and tried to pull out their money, causing a vicious, self-enforcing bank run. The crash bankrupted many investors and pulled down the entire crypto market with it. Over $400 billion in value was wiped out in terms of crypto market capitalization. This is among the most painful weeks in crypto history and one we'll reckon with for a long time to come. Jake Chervinsky, the head of policy at the DC-based lobbying firm Blockchain Association, wrote on Twitter, "While Terra investors were the ones most immediately hurt, its downfall could have both short-term and long-term ripple effects for crypto and beyond. Especially as skeptical legislators and regulators survey the damage. People have lost their life savings through crypto investments, and there aren't enough protections in place to safeguard consumers from these risks," Massachusetts Senator Elizabeth Warren wrote in a statement to Time. "We need stronger rules and stronger enforcement to regulate this highly volatile industry. Here's what happened, and what lies in store following the debacle." What happened, exactly? Terra's rapid rise and fall can be difficult to explain succinctly without any prior knowledge of the blockchain. In fact, many of its boosters hid behind obfuscation and jargon to rebut some of its obvious flaws. Here's a brief explanation. Terra is its own blockchain, just like Bitcoin or Ethereum. Its foremost product is the US stablecoin, which is pegged to the US dollar. Stablecoins are used by crypto traders as safe havens for when markets and DeFi get choppy. Instead of converting their more volatile assets into hard cash, which can be expensive and trigger tax implications, traders simply trade them for stablecoins. Some stablecoins derive their value from being fully backed by reserves. If investors decide they ever want out, the stablecoin's foundation should theoretically have enough cash on hand to repay all of them at once. UST, on the other hand, is an algorithmic stablecoin, which relies upon code, constant market activity, and sheer belief in order to keep its peg to the dollar. UST's peg was also theoretically propped up by its algorithmic link to Terra's base currency, Luna. For the last 6 months, investors have been buying UST for one main reason: to profit off a borrowing and lending platform called Anchor, which offered a 20% yield to anyone who bought UST and landed to the protocol. When this opportunity was announced, many critics immediately likened it to a Ponzi scheme, saying it would be mathematically impossible for Terra to give such a high return to all of their investors. Terra team members even acknowledged that this was the case, but likened the rate to a marketing spend to raise awareness, in the same way that Uber and Lyft offered severely discounted rides at the beginning of their existence. But some blockchain experts say that last week, wealthy investors pulled off a maneuver in which they borrowed huge amounts of Bitcoin to buy UST, with the intention of selling. This caused UST to depeg from the dollar. A bank run ensued, with investors who had earned interest via Anchor scrambling to get out the door before it was too late. Their activity caused the linked currency Luna to also crash in what is known as a death spiral. As of now, UST is worth 12 cents. And Luna is worth fractions of a penny after being worth as much as $116 in April. The life savings of many Terra and Luna investors vanished in a matter of days. The Arteral in a subreddit filled with people opening up about their mental health issues and contemplating suicide. "I'm going through some of the darkest, most severe mental pain of my life. It still doesn't seem real that I lost $180,000, one poster wrote. Terra dragged down Bitcoin and the whole crypto market. Before Terra's crash, cryptocurrency values were already on the decline, due in part to the Federal Reserve raising its interest rates. But UST's crash put another dent in the overall market, most centrally because Terra creator Do Kwon had bought billions worth in Bitcoin as a safeguard for UST. When he and the Luna Foundation Guard deployed more than $3 billion to defend the peg, in doing so he caused downward pressure on the market, causing other large investors to sell off their Bitcoin shares. Bitcoin hit its lowest point since December 2020, and Quan's ploy to save boost was unsuccessful. The way these algorithmic stablecoins are designed, they have this upward force during bull markets, which is how they get so popular, says Sam McPherson, an engineer at MakerDAO and the co-founder of the software design company Bellwood Studios. But the same forces act in reverse during bear markets and expose their fundamental flaws. So that is eventually what triggered the ripple effects were felt throughout the crypto ecosystem. Because firms sold around $30,000 of Ether in their own attempt to defend Deuce Peg, Ether also plunged below $2,000 for the first time since July 2021. As many investors try to cash out their Ethereum-based stablecoins, their sheer number of transactions caused Ethereum's transaction fees to spike, causing people to forfeit even more money. Coinbase, one of the crypto world's biggest and most mainstream companies, slumped 35% last week. And the NFT ecosystem plunged 50% over the last 7 days by sales volume, according to CryptoSlam. The cumulative effect was the loss of hundreds of billions of dollars across the ecosystem. Many worry that Terra's crash is the first domino precipitating a long foretold crypto winter, in which mainstream investors lose interest and values remain low for months. I suspect some cryptocurrencies will be worthless and that capital investment in the space will slow to a crawl as investors nurse their losses, much as we saw in the internet bubble, Bloomberg's Edward Harrison wrote. So, what could happen next as a result of the crash? Regulations could tighten. Stablecoins have long been drawing the scrutiny of regulators. Congress held a hearing weighing their risks and benefits in December. The same month, President Biden's working group called for urgent action to regulate them. Terra's crash gives even more ammo to regulators who argue that the space needs to be roped under government control. On May 12, Treasury Secretary Janet Yellen called for comprehensive regulations of stablecoins, saying that while the current crash is too small to threaten the whole financial system, stablecoins are growing very rapidly. They present the same kinds of risks that we have known for centuries in connection with bank runs. Hillary Allen, a professor at American University Washington College of Law who testified about the risks of stablecoins at the congressional hearing in December, says that the fallout of the Terra crash gives us a glimpse of what could be in store should crypto move toward the mainstream without regulation. In a few years' time, something like this could have many more pathways to cause broader harm, especially if the banks continue to get closer to this space, she says. I think it's critical that regulators and policymakers see this moment as a time to put up whatever firewall they can between the traditional financial system and DeFi. Massachusetts Representative Jake Auchincloss tells Time that he's in the process of drafting legislation requiring stablecoins to be federally audited. Auchincloss doesn't seek to ban stablecoins, as he believes they could play a role in keeping the US dollar as the world's reserve currency. But he hopes to bring stablecoins under the purview of a federal bureau like the controller of the currency, to make sure stablecoin issuers can prove they have 90 days of liquid reserves, and to explore the idea of mandating that they provide insurance for customers. We're going to let private sector actors make their own risk-reward decisions, and we're going to empower the federal government to ensure that there's no systemic risk forming from the sector, he says. Senator Warren has been one of the most vocal public detractors of crypto, and took Terra's collapse as evidence for why regulators need to clamp down on stablecoins and DeFi before it is too late. Across the Atlantic, the European Commission is considering implementing a hard cap on the daily activity of large stablecoins, according to CoinDesk. Much of the crypto world, meanwhile, seems to have become resigned to the reality of incoming regulation. A lot of lives have been ruined. The rest of the crypto ecosystem needs to be open to working with regulators such that we can deter these types of situations from happening in the future, McPherson says. Boundary-pushing stablecoins might be over. For many years now, ambitious blockchain developers have embarked upon the quest of creating a functional and safe algorithmic stablecoin, in the hopes that they might be more resistant to inflation than reserve-backed stablecoins and less susceptible to governmental oversight or seizure. But all of them eventually lost their peg and failed. Oost, for a few months, was the medium's crowning success story, and now is its biggest failure. Its crushing defeat will cast a long shadow over any developer that tries it next. Venture capital firms and investors will likely be much more leery of jumping into similar models. Two other boundary-pushing stablecoins, Frax and Magic Internet Money, saw massive drops in their market caps last week despite holding their peg to the dollar. I think this has rightly destroyed any faith in the algorithmic stablecoin model, Allen says. It's quite possible after Terra, we might never see them again, although I never say never when it comes to crypto. Over the last week, many leaders in the crypto community have scrambled to distance Oost from other types of stablecoins, arguing that reserve-backed stablecoins are comparatively secure and should be allowed to continue to flourish with minimal regulation.